So I think what people get wrong is mostly what they are selling rather than how they are selling it. Like most people get the what of it wrong. And they like if you try and like most people are basically stuck trying to sell a product which nobody wants to buy. So usually something has to change in the world which makes this idea a good idea now. Okay, because if you most startup ideas, if you really think about them, they've been tried and in some format or the other. Getting to a Series A is not a definitive answer that this is now made it. Unique space exists where there's a big problem for a small number of people, but that number is growing very fast. Okay, so that is a very sweet spot to sort of start a startup. The industrial revolution scaled manufacturing. AI is going to scale services.
Hello and welcome to another episode of the KVKurious Podcast. Our guest for today is Kushal Bhagia, who is the founder of All-In Capital and previously led Firstcheque. Kushal is a founder turned investor, and this conversation is a playbook on how should early-stage entrepreneurs build their thesis around the timing, around the market, around their business model, go-to-market strategy. How do you pick the right set of investors? How do you know how much should you raise and when should you raise? How do you go ahead and build your ideal pitch? And much more. In this conversation, Kushal also speaks about his journey through the years. What do entrepreneurs typically get right and typically get wrong? How is sales important and relevant in the world of startups? But how is product-led growth all the more important? And much more. So this conversation is going to be super insightful. Thank you for staying tuned with me. Listen to Kushal Bhagia on the KVKurious Podcast. Hey, Kushal. Thanks for joining my podcast. Super excited to have you.
Hi, Krishna. Happy to be here.
One thing that's been, I've been intrigued by is the kind of names you've come up with for your VC firms. Firstcheque, All-In. Seems like pretty obvious names and most compelling names, but no one has done this before. It's as compelling as if, Postpay or Bharat Pay. How exactly do you come up with these names?
Thank you. I think I appreciate the compliment. So to be very honest, Firstcheque, the name I didn't come up with. I was recruited by India Quotient to run that fund end to end. But that name, it was a good name. All-In I came up with because so somewhere around the third year of running Firstcheque, I realized this is now what I want to do for the foreseeable future. I want to build a career, backing early stage founders. When I had taken up the Firstcheque role, I thought I'm actually a founder, and I don't know if I thought I'll be a investor for 2-3 years, and then maybe I'll go back to building a business. But by the third year, I realized that I was really loving it and I was really enjoying doing this, and this is what this is my founder market fit. So I realized this is what I want to do for the next 10 years. So I was committing to it for the next decade at least, and hence I was going all in, and hence the fund was called All-In. But also another realization I was sort of inspired by the founders that I was working with. Like by the third, fourth year, I realized that there are a class of people who just don't give up, and they really do put everything on the line, and their success is not an accident. Like it was a matter of time for this type of people, and the common trait was this level of commitment to what they were doing. Like there are these guys who meet who that okay, even if it doesn't work out for them on this venture, this person, if they continue with this level of commitment, luck will work out for them at some point. And all of them were basically all-in entrepreneurs, right? So that's what I realized you need to do to it's a necessary condition to really make it big, and that was the other reason. And third is I think it was a good sort of short form for All India Capital, so that rang well as well. And these were the reasons. Plus I loved that All-In podcast as well. So that sort of all of these like sort of lined up, and I said, let's just start a fund called All-In Capital. It's a nice pun as well, right? All-In Capital.
It is. Okay. Before we get into the fundraising part, you graduated in 2012. You got your bachelor's in MEC.
Yes.
From there, you've done, whenever you've been associated as an entrepreneur or as a part of a startup, it was mostly in the world of education. How exactly did that jump happen? What led you to start, the Kaju character and all of that?
Yeah. So honestly, back then, I would say we were naively optimistic or naively stupid. I don't know, however you want to put it. In 2012, actually 2011, the Steve Jobs book had come out. I had actually discovered Steve Jobs in 2010. I had read a book on him, and then the actual, authorized biography by Walter Isaacson came out in 2012, and that just blew my mind. I was like, this is what I want to do. This guy is cool, man. Like this is the career I want to build. I want to create a dent in the universe. I want to go start a company, and I like it just like a one window opened up in my world. So I was clear that I want to start a business and start a tech company. I had another crazy friend like this in my hostel who had also read the book and was also as crazy, and we both teamed up and said let's do this together. His name was Karthik. Uh, so we ran one social media business on campus. We tinkered around with some other ideas. Then he went to HP Labs in Bangalore, where he got to work with a Kinect as far as for his final year internship. And there he figured, ki, okay, this could be a good way for kids to interact with computers, because back then already the hate by parents and educators against screen time had started. So child typically slouches down and interacts with the screen with no body movement. It's a very unnatural sort of mode for the child to be in. Otherwise, children always jumping, clapping, always
But
physically.
back in 2012, smartphones weren't so prevalent, right? I think in 2013 is
It
when
started
the
happening. No, so I would say internet had not reached, of course, the penetration it has today, but at least in tier one India, everybody had a phone, and their kids also from say fifth, sixth class onwards had a phone, and everybody there was in fact these channels on YouTube called Choo Choo TV, etc., which had already become huge. So this trend
okay.
of children only eating when they are watching YouTube videos, that this had started. Like everywhere you go to a restaurant, the child would be on a phone. So this had started, and it was quite clear that people don't like it, but they didn't know what else to do, so they were basically going along with it. So we thought, okay, the Kinect is a much better medium of interaction for the child to have with the digital medium, because here you are physically active and you can we do body movements and
Hmm.
interact. And then we married that with education and said, okay, then we actually discovered one more thing, that there's a class of learners called kinesthetic learners. So there are people learn in different ways. There are people who like to learn by visually, which is by seeing. People who like to learn by auditory senses, or audio learners, and then there's kinesthetic learners who like to learn by moving. And this class of people is always sort of underserved, because the typical classroom, the teacher talks and you can see the board, but there's not, you have to sit in one place and just listen to her for 8 hours a day, right? So we felt, okay, can we design a product where the child is physically engaged and get them to learn via physical body movements, and that gets reflected on the screen. So that's how it happened. Honestly, there was no see, one reason why we went to why we chose education as a category. But we actually chose the Kinect, and then we figured out, okay, this could be a good application. And in hindsight, that is one of a classic engineer mistake, like to get enamored by
Yeah, excited by
technology
tech.
and not go problem first. But anyways, we went with it. We then by year three, the company had about 100 plus paying customers. Many schools in India had bought it, like Podar, Eurokids, Kidsy, Ryan International. Many of them, a lot of them still use the product. But yeah, that was our sort of. It was basically two 21-year-olds, just fumbling their way through. Okay, let's start a company, and like this is what we chose, and it just happened.
Interesting. And what did the venture result into? Like before you got into Upgrad, what was the end state of your venture?
And it didn't work out, unfortunately. So the product was great. We had a lot of user love, like the kids would love playing our games. But there was no, what we realized by year three is that the schools are a pretty bad segment to sell to, both in India and abroad,
Okay.
because they always like sort of strap for budgets. And they at least in India, there is very, very it just takes a long time to sell to any school. Even if you are doing a deal of say 50,000 rupees or 1 lakh rupees, it will take you 6 months to win that deal. So that means your guy has to go and pitch and talk and do demos, meet everybody from the pre-primary teacher to the principal and the trustee. Sometimes even parents you have to go present to. And
Hmm.
after all that, dog and pony show, you will make 1 lakh, 2 lakh rupees, 3 lakh rupees. And that also they'll not pay you on time. You have to follow up for your money. Sometimes they'll renegotiate contracts. So typically people who have been selling to schools and colleges in India, they have not been able to scale large businesses, because the
Mhm.
offline sales thing just doesn't scale. Another reason for it is that schools like if I have to look back and hand on heart, think, okay, why did it not really work? Because honestly, the schools don't really need this. Like their main goal is to cover the curriculum. Okay, so that is what they're
Correct.
regularly mandated to do. That teach this topic in this standard to this child and make sure they don't fail, right? So that is what they will always focus on. So unless you build a product which is helping them achieve that goal directly, right? Then that becomes or it's mandated by the government that you have to buy this. Then there's a chance they'll buy it at scale. Till then, otherwise, even I don't think any other company is also successfully scaled by just selling to schools.
Hmm.
Uh, so it's a very tough market to play in, just because this offline sales thing doesn't scale. And by year 2, 3, we had met founders who are IIT, IM guys, been doing some kind of school sales business for 5 to 10 years. Um, Even they had reached like 500 schools or 600 schools, 700 schools. Like there was nobody who had reached 20,000 schools. It just, I don't think even today anybody has that kind of reach. Uh,
Mhm.
so it's a structural problem in the market basically, and it's going to be hard to change that for a while. And which is why B2C edtech has worked much better than, this B2B edtech. So that was a learning we had by year 3, that like you can't scale a business by selling to schools. We then pivoted and we tried to do 3, 4 other things by, building consumer tech products, but by then we ran out of steam, and unfortunately then we had to move on. So yeah,
Int-
that was the journey.
Interesting, but since you mentioned the original problem statement was that a kid spends much time on the phone, especially when eating and stuff.
Yeah,
Now, all of these activities are typically outside of school.
yeah,
So, by and large, the solution that you built for students or kids must also be applicable outside of their school hours, right?
correct.
So, wasn't it a viable solution that you convert this into some form of B2C business where it's parents who are sort of
So we did
purchasing this?
that. We did
Okay.
that. So the Kinect itself was not a platform which is, even today, it's not widely adopted, right? Like in India also, if you go around seeing, people don't have Kinects in their household. Like it is nowhere close to the
Right.
population that phones have. Even in the US, most people who have an Xbox are hardcore gamers. They're not uh like the parent
Yeah, they're
audience.
not. Yeah.
It's like a bachelor's product, right? Like boys
Yeah.
buy Xboxes and play on it. So the Kinect actually didn't really work as a product itself. So there was no mass platform where we could sell it on. We tried to build the same thing on mobile, where the phone's camera detects your child's body and the game gets cast on the TV. This app is still live on the App Store, and we try to sell it, but I guess we were not too good at marketing it, and we had only done this B2B offline sales ourselves. So I would say maybe we didn't really. Maybe we could have raised more money and have built a team who brought on those trends on board. But that is something which we didn't do really well at. We built the product. There were other issues with this product, that you needed space in the room, so you need to cast the game on the TV, and like when you build games, right, there has to be a very low friction to get started with the game, right? For our product, there was a lot of friction. You First of all, the user is not a downloader. The parent has to be sold. The parent
Right.
downloads. Then the parent has to cast, like has to put the phone below the TV, then has to cast the game on the TV, and then the phone captures the child's body. And you also need space in the room, and you can't leave the child alone, because if they're playing and like they crash into something, then they'll get injured. So somebody has to also watch over them while they are playing. So it was
Hmm.
a lot of steps to build a great experience for the child, and I think that friction was also a big problem. Another direction we went with is, let's take our IP, which is the character Kaju, and create like web series around it, or create a story around it, like Peppa Pig or like Sesame Street. So that is some direction we wanted to go deeper in, but then we ran out of money. So we couldn't really do that as well. So yeah, we tried like 3, 4 different things, but in hindsight, I see hindsight always 2020, right? Tech boom did come. So 3, 4 years later, it like this is 2012 to 16 is where we were really giving it a full shot. Then uh, EdTech became really hot somewhere in 18, 19,
Yeah.
Top
Yeah.
and Baidu, and these guys started raising big money. But they had a way more aligned. See, the problem they were solving actually made a lot more sense, that my kid wants to learn math or English or science and he's not learning. And there was a clear offline equivalent of it, which was tuitions. So they basically said, let's do tuitions in a way online. And academic sort of supplemental edtech is what really worked in India. Not non-academics or fun and games. And that piece is always a optional thing for most parents. So it doesn't scale. Some parents who are, very who go out of their way to explore new products and try new products for their child, they will come and adopt these kind of products, so they remain niche. For mass market, what is going to work is products like stuff which helps you crack IIT JEE, helps you crack to 10th standard boards, 12th standard boards, and something which every child has to do. That kind of market is what you have to go for if you want to build a large business.
Interesting. But you'd also raised some funding for
there is a small
startup, right?
2 crore rupee round is what we had raised.
Yeah. So was it ever concerning you that first startup mein kand ho gaya, abhi dobara paisa milega ya nahi? Any of those concerns?
Yeah, as a first time entrepreneur, you do feel bad that you raised money and it didn't work out. Nobody made anything back out of it. I don't know.
But does that impression actually continue henceforth that this first timer messed up and he might be a risky investment?
Not really. Like I have, for example, now when I'm investing, there are many people I back who've done a business in the past where it didn't work. I think as long as you gave it your best shot, like as that investor should not speak badly about you, right? Like they should say that okay, he tried his best, right? And things didn't work. When you take a bet as an angel or a VC, this is a likely outcome that most companies don't work out, right? That's the odds.
Right.
9 out of 10 companies in the startup world, they don't work because you're trying something new, and by definition, doing something new is harder than doing something which already works. So it's a failure is a part and parcel of the game. I don't think ऐसा कुछ था कि maybe in 2015-16 लग रहा था कि who will now back us again, or actually more than that, I actually think who will give me a job, because I had done such very different things as a founder that I didn't know what job to apply for, because I had done a little bit of everything, right? Whereas by the time I was looking for a role, when you join a company, you are given one particular department or one team you handle, and you do one particular role, right? Whereas as a founder, you do 15 different
multiple things. Yeah.
So I didn't know what to slot myself in as, and but then luckily Upgrad worked out. But yeah, like I wasn't too worried about not being able to raise money again. I think people are more forgiving than that, and usually second time founders are a little more mature, and having been burnt once, they they at least know they know some things which they should not do again.
Yeah.
So it's still hard, and it's still very, very difficult to build a large business, but at least I usually it's a safer bet to back somebody who's done it once before, even if they failed in the past.
Very interesting. So like you rightly mentioned, founders typically come with this sort of jack of all trades kind of trait, right? So from there to narrowing down on a specific role at Upgrad, what was your thought process? How did that happen?
So that time I was feeling very dejected that I couldn't run a business. So I was like, okay. Also, generally there was a lot of gloom and doom. Like I don't know if you remember this. It's a lot like the current climate in 2015 and 16 beginning also, right? A lot of the euphoria of startups had sort of died down because same stuff. People were shutting down companies. People who had raised 10, 20. It was at a smaller scale. There were like a lot of 5, 10, 20 million rounds that had happened in 2014 and 15. And by 2016, there were a lot of these companies were shutting down. So there was a big question mark at that point, that is this even real? What is this startups? And none of them make money. They're not profitable. They don't make any revenues. All this is bakwas. So this was a climate, and in the middle of that climate, even I was sort of questioning, okay, I couldn't understand, like I built a great product, but I didn't really understand what is a good market, or how to scale things, how to raise VC money. So let me go join somebody who has built a large business in the past. And that's where the Ronnie thing happened. So Upgrad was started by Ronnie Stuala, who had built and sold UTV earlier. So I thought, let me go work for somebody who's done that in the past, and maybe I learned something which because I couldn't run a business on my own. So let me go work with somebody who has done that. That was basically the idea behind it.
So you just cold emailed him telling I'm a previous
ex-founder from Bits was working there. He referred me. I didn't email him actually. I didn't know about I was looking for roles, and I was looking for roles in Mumbai at that time, and I had asked 3-4 friends, if you know something, let me know. So one of them referred me to the CEO of Upgrad, Mayank, and then that guy, the Mayank, basically Ronnie was a final interview in the process. But yeah, that's how it happened.
Interesting. And what? How did you progress through Upgrad, and after that, by the sudden transition to VC?
So Upgrad was a lot of fun. When I joined, there were like 30, 40 people, I think. And when over 2 years, it became 700 people. So the company really grew very fast. Uh,
Right.
Ronnie also had invested a lot of money and time and effort into building this with Mayank and the other founders, Falgun and Ravi. So it was a great experience. I got to work closely directly with them. Um, uh, I think the company was basically building educational programs for working professionals. So people who are
Right.
already doing a job, who want to upskill, who want to do more than achieve, more than what they're currently doing in their current job. Everybody has aspirations that like I'm doing this today, but what do I want to be doing this 3 years, 5 years from now? How do I progress in this career? And education is the obvious answer that okay, if I pick up new skills, I can progress faster in life. And that was basically the thesis of the company, and it made a lot of sense that um, this kind of supplemental education had become possible because of the internet. Till 10 years, 20 years back, if you wanted to do this, you would have had to go to do weekend classes. That too, if you're lucky, if there's something in your city, then you might, there's traveling involved and you may not get the best faculty or so on. But with Upgrad's model, you could go get a really good college like BITS or Triple IT or Cambridge
Mm.
and create a program with them, put it up online, and then learners can just do these programs whenever they have time after work or on weekends. Or there were a lot of people who would listen to the courses while sitting in their bus on their way to work also. So my role there was to build partnerships with corporates. So I led B2B partnerships for the first 2 years, which meant doing, getting companies to create programs with us. So we partnered with companies like Uber, InMobi, Genpact. Like many of them came and did case studies for our students. They actually recorded lectures with us. We did The second part of my role was to get these guys placed. So when they finish the program, if you want to transition from a software engineering role to data science role, right? We need to get companies who would come and hire you. Look at
Mm.
it. So that was actually the bulk of my work was this. From at least after the first 6 months, this is what we were focusing on. And the third piece was to get companies to co-create content. Sorry, to use our programs for their own employees. So, for example, in Mobi, I had given all Upgrad programs to their existing employee base, or there were other companies who had tied up. We also created custom programs for certain companies
Mhm.
to upskill their workforce. So all these three things I did for about 2 years, and by the end of 2 years, it had like become a radically different company because, as I said, it went from like one small office to two floors and one Bangalore office, one Pune office, and so it had just exploded, and it just felt a little different after 2 years, and I felt that okay, I got what the learning and the experience, exposure, etc. that I wanted. I really had fun, and I got what I was sort of looking for, and I was sort of itching to go start a company again. So with
Mm.
that goal, I spoke to Mayank, and then I moved out after 2 years at Upgrad. After that, I spent about 6, 8 months exploring startup ideas again. I went through 4, 5 pilots. Um, I tried something in solar financing. I tried something in offline to online commerce. Uh, I tried something in gaming. So there was 2, 3 things we tried, and but this time I was doing it alone. It wasn't with somebody, and I realized that in hindsight that was a big mistake because, at least for me, I don't function that well when I don't have a teammate. Uh,
Mhm.
and by like 7, 8 months into this journey, I realized I'm not getting anywhere. Like I tried 4, 5 things. I thought this is the second time I'm doing this, so it'll be much easier, but it wasn't to like it's not like that 0 to 1 thing of coming up with something which really clicks with the audience. I wasn't able to like get anywhere seriously with it. So I went to these guys, India Quotient guys I knew from before. It's a seed fund based in Bombay. I went and told them that, look, I'm exploring these ideas and can you hire me as a EIR? Because my personal runway was running out. So I said, can you hire me and I will spend half the time working with you and half the time I'll explore ideas and I'll start something. And if you like it, then you fund me. A lot of VC funds do have this kind of program. It's called entrepreneurial in residence. So they said, we don't have this EIR thing at all, but we have a job. If you want to do we have this idea called Firstcheque and you want to launch it,
Mm.
and if you want to do it, you come and run it, and we can make that happen. So then I thought about it and said, okay, I don't have anything clicking right now, and anyways I'm looking for ideas, so why not take this up, and it'll give me some more exposure in the VC startup world. And if I get some idea and 3 years later I can start something, maybe I'll meet a co-founder through this, or I'll
Hmm.
understand at least how VCs think. And so I took it up, and yeah, then I just ran with it after that.
Very interesting. Wow. Okay. Uh, but one thing that constantly came up was you doing B2B partnerships or B2B offline sales, be it at your startup or be it at Upgrad, trying to negotiate, partnerships and companies and stuff. Is there something that people typically get wrong in negotiating these deals that you seem to do better?
So this I can speak a lot about, but where do I start? So see, my one big learning was when you sell. So I've sold too many things from my college days. I've basically been a sales guy. So at my heart, I'm a salesman, and I've sold T-shirts, concert ticket, newspaper subscriptions. I sold the social media services business. Then at Nayi Disha, I sold products to schools. At Upgrad, I sold these partnerships. At VC, also you're kind of selling your capital to the best founders, right? So sales is one of my core skill sets. I think the one learning you will, at least for me, it's like the product is very important. Like when you're selling something, right? So I would like to believe I should be able to sell whatever I want as long as I believe in it. But when you sell a bad product and a good product, right, you really understand how a good product sells. You don't really have
Hmm.
to sell it, and then you have to just sort of listen to the customer and figure out how this fits into their life. So I think what people get wrong is mostly what they are selling rather than how they are selling it. Like most people get the what of it wrong, and they, like, if you try and, like, most people are basically stuck trying to sell a product which nobody wants to buy. That's the reality.
Hmm.
Is why most people cut the cold calls they get, or like nobody likes to meet a salesman because usually they're selling something which you don't want. Correct. So that's, as an entrepreneur, that's step one. You have to figure out what do people want. Like if you just build something which people want, then they come and grab it from you, and you don't have to sell it. So you have to sort of
Hmm.
go back. That was my one big lesson. Like as a VC, when you're handing out checks to people, right? There's a line of people waiting also because obviously they want money, right?
Right.
So
Yeah.
you don't really have to sell yourself, but you have to sell yourself to the guy who has multiple offers. But otherwise, if you're handing out checks to people when they're starting companies, there are enough people who would show up at your door to,
Oh yeah.
so that's when you start selling anything. That's what you should think of first. Key, why aren't people buying this, right? Like, why is it not flying off the shelf? And if it's
Hmm.
not flying off the shelf, then likely means you are selling something which people don't want. So just to double click more into why that is happening. Uh, Otherwise, I think if you land upon something which people do want, then you're very lucky. And then the way to scale it is basically what people get wrong, I would say, is most people treat it as a treat the person as the other end as a number in their Excel sheet. Okay, tick tick tick, we made 100 calls today. Like, but if you really want to do big deals where running into the hundreds of thousands or millions of dollars, then that is all relationship based selling. So you have to sell to the person, meaning that guy has to
Hmm.
finally like you. That is what ends, like, end state. That is what needs to happen. Somebody in that company, ideally multiple people in that company, need to like you. Like
Hmm.
subconsciously they should look forward to you visiting their office. कि, oh, आज कुशल आने वाला है, चलो उसके साथ चाय पियेंगे, we'll do like, so that is not easy. Like, to be able to break through somebody's uh working life. Everybody's busy, there are 10,000 things going on. So be able to convince them that like subconsciously, to get them to like you, that is a huge challenge. And I think other sort of way to look at it also is, how can you position you or your product as something which will directly benefit them personally, like not just the company, the person you're selling to. You need to show a clear path that this is how this will meet your KPIs, or your internal standing will go up because you champion this product, or this
Hmm.
because of you this product was sort of implemented in the organization, etc. So you have to figure out a way where your whatever you're selling leads to that for somebody in the organization on the other end. uh yeah, like that's basically the essence of it, but there's a lot more. I think there are many other tips, like just never stop following up. uh Always be selling is also true. Like, there are opportunities come from the wildest of places. So the best sales guys are like always Like wherever they are going there, like even if the opposite guy is not really a customer, they're still shilling their product. Uh, so yeah, like there's a lot of things you can imbibe from this.
But that's kind of contradictory to what you was told on the start, right? Like, are you selling to the right guy? Because when you're always be selling, and you're
Yeah.
always selling even to a person who is not potentially a customer, and that's maybe when you're getting it wrong, right?
You have to break a lot of eggs to make an omelette, right? So if you hit enough doors, like at some point, one of the doors will lead to a pot of gold. So there's a lot of brute force also involved in this, but doesn't mean you harass everybody who opens the door, right? You just check quickly, move on, check quickly, move on, right? But you have to sort of have a sort of knows for where opportunity lies, and if you knock on enough doors, and then you have to judge whether it doesn't merit more time to be spent here. But the
Mhm.
moment you see an opportunity, then you have to barge in and figure out a way to make that work.
Interesting. Uh, okay, and before we speak about startups, it's funding itself. How did all in happen?
So by year three of Firstcheque, it was quite apparent that I like what I'm doing, and the founders I work with like me too. And we had gotten into some really good companies that were doing quite well. So Jiva is now doing really, really well. Mail Modo is doing well. Riggy, Rocket Lane,
Hmm.
Super K, Anar. There are many others that had raised like 2, 3 rounds of funding, and there was PMF had happened, and we could see that these companies will amount to something. Like these are good picks. Wint12 was one more. Um, so and like I was also at this point directly getting to when Firstcheque started, we were in this mode where like the thesis given to me was that you build a network of founders, let them source companies, and then you invest with them wherever they are investing. Okay, so I built a network and founders. And what I realized is then that the founders actually don't have the time to do this more than 1 or 2 hours a week, or sometimes 1 or 2 hours a month, because they are running their own companies. So they are not too bothered about getting into every hot deal or every good company. They will, by and large, fund their friends or some people who come to them that they like. They will put money in like people they know essentially. Uh, but what started happening is that because I had written about all this online, that we are this network of founders, come raise money from us and so on. A bunch of people started coming to me directly because I became viewed as a gatekeeper to all these founders. That okay, if you get him on board, he will go get one of these founders on board, and then your round will happen. So by year 2, 3, a bunch of deal flow just started coming to me directly. And a
Hmm.
lot of these companies I mentioned also, right? They came to me and I liked them, and I brought a founder angel who knew the space and we invested. Like so Wint12, for example, I sourced Riggy ad, sourced Super K ad. So many of these companies are now at Series A plus level. I knew the founders through my network, or they just cold mail me or approached me online, and I liked what they were doing, so we funded them. Uh, so then I realized, okay, if I'm sourcing these guys, I'm picking where I'm investing. Then why not just go do my own fund now? Because this end to end, I'm basically doing everything that a VC should be doing. So then I just decided, okay, let's. I anyway wanted to be a founder. I've realized this is what I'm good at, and I'm enjoying this. So yeah, let's do it. And like that was a decision point. And then I spoke to the IQ guy, and then I moved out. So end of that year, I transitioned out, and the next year I started setting up all in.
Okay, so the way I understand is it was easier for you to build a fund because for you building a fund wasn't an outbound activity. It was people had already started coming to you, telling we want our capital to be invested. You do the job.
Oh no, so that was a bit of both. The people said the deal flow had happened. So my brand had become like I had enough followers on Twitter, LinkedIn, I had done a YouTube series. So at least on the so as a VC, you do two things, right? You have to source you have to source founders that you want to back, and you pick out of three things. You source, you pick, and you invest, right? And then you need money to invest. That's the fourth thing. So the money part, some of it was known. Like there were people who used to invest. Firstcheque also used to run through an angel list syndicate model, right? So there were a bunch of people who had discovered me or Firstcheque because of angel list. So there was a audience who knew that okay, this guy picks good companies, but there was a lot of outbound that had to be done to raise the fund. So there were some people, I would say, out of the 10 mil fund we raised, maybe 40% ish was people who already knew me, and the rest
Hmm.
60% was like, can you introduce me to more people who want to invest, and a lot of basically hustle from there on.
Interesting. Since you mentioned about the YouTube series, although I mean I've been listening to interviews and stuff, but I think the first time I actively um, got drawn by a podcast was one conversation that you did with Vidit and Sanjeev.
Yeah.
I think in 2021.
Yeah.
I think soon after they became a unicorn, or slightly before that.
Correct.
Yeah, I think that podcast really changed how I thought about entrepreneurship and everything else. So thanks for that.
That was a great one. Vidit's an awesome guy, and that was a good conversation.
Yeah, that really changed a lot of my outlook.
Thank you.
Interesting. So now when you invest in startups, what is the one thing you look for? Because like you mentioned, all your deals are not sourced through the founders, right? There are many cases where founders reached you directly, and despite you may or may not having experience in that domain, you just thought it is good, and so you try to take it further.
Yeah.
So what is really that point of conviction?
So there's a step to it. I would source the deals, but I would still involve a founder angel who's a domain expert. So if it's a fintech deal, I have a friend PJ who runs a stock exchange called HQ. Usually I call him and he'll give me a point of view. If it's gaming, Shubh, MPL founder is whom I'll call. So there are that network still exists, and I use them heavily for domain diligence, and vice versa. Also, if they're doing a deal, they can call me and ask me, what do you think? Have you seen any other company like this, and so on. No, but to answer your question of what do we look for now is one is the two obvious things are like large market and good team. That is something that every VC looks for, where there has to be a large sort of space, opportunity to do like 100 million in revenue 5-10 years later, and an exceptional team which has a clear sort of right to win in that space. Beyond that, like how we evaluate that is, we look for something called a why now. So usually something has to change in the world which makes this idea a good idea now. Okay, because most startup ideas, if you really think about them, they've been tried and in some format or the other. Yeah, so we look for a why now because usually something needs to change in the world to make an idea a good idea today versus because otherwise good ideas generally have many people trying them. Like it's very rare that only one guy did one idea, like they had no competition. ऐसा नहीं होता. People usually, that's why you see these startups in droves, right? Like in e-commerce, there were 3-4 of them. Food delivery, there were 3, like there were 10-20, whatever, right? So usually when there is a good idea, many people start to do that. So if something is changed now in the world, what is like for example, if you take grocery delivery, right? People tried it in 1999. People tried it in 2005, people tried it in 2010, and then it kind of worked because after a point, internet penetration was good enough for logistics, it was good enough for it to work. So usually this why now answer has to be technological. There has to be some new technological change in the world which makes this possible now or scalable now, right? So like for example, you can say the Zerodha became possible after a point when internet speeds became good enough for this kind of online trading to happen. Actually, more than that, web technology became good enough for their UIs and all to be clean and so on. Zerodha maybe not the greatest of examples. Let's say from like from our portfolio, Mailmodo does AMP based emails where you can interactive emails. You can do basically interactive experiences within an email. So you can submit a form in an email. You can play a game within an email. You can do a transaction within an email. So all this is possible because of AMP, and AMP came out recently. It's a Google supported protocol, right? So because AMP exists, hence Mailmodo exists, right? So or if you take an example again, like we had done this company called Jiva, silver jewelry brand. Gold prices had become too expensive, so you can't wear gold to work anymore because it's just too expensive. And women were now in India wearing Western wear to work by and large. So gold jewelry doesn't go with that, and artificial jewelry looks cheap. So silver fit in this great spot where it goes with Western wear, and it's at that price point where it's 2,000-3,000 rupees. You can just click and buy it on impulse. And it's a good replacement to gold, which still feels that like it is valuable after all. So clear trend and clear why now there. But yeah, usually we look for a technological why now. If we can see a new sort of a new experience, new consumer experience is possible because of a new technology or a new market has opened up because of a new technology. Sometimes it's a regulatory why now that this happened, this got banned, so now you need an alternative. But that why now piece is usually very important, and then comes the founder's sort of right to win. Like, so once why now sort of establishes that this is a good idea, after that we look deeper into why is this the founder who will uh, win this whenever this
Space, yeah.
whichever, like, because multiple people will try. So why would this be the person to win this space is the other question to then ask. So
Mm.
broadly, yeah, that is the framework.
But when you ask why will this founder win, and questions like this, how does it really hold uh, relevant for, let's say, someone who's starting out right out of college, for instance, who
Yeah,
doesn't come with significant experience?
it does hold like so a lot of the college founders we back, right? You may look at them and think that, oh, he's only 21, he's no work experience. But actually, there are people who've been building stuff since they were 17 or 15 also sometimes. So
Right.
even though they don't have formal work experience, that doesn't mean they've never built products. Yeah, in fact, most of them, it would be their fourth or fifth product by the time they're
Mm.
graduating from college. So they're exceptional builders. And it's so I don't view them as people with no experience. There are, of course, people who suddenly decide in fourth year that they start a company, but then those are not people usually that we back. Our pattern of founders that we have seen is they are usually hackers. They have been doing this since they were kids or they were like 15 years old, or at least 3 4 years is usually the pattern we see. So yeah, that's that. There is some past to it, but there also usually you find that they are at people who are in college are generally exploring these fringe technologies which are fringe today but which become mainstream tomorrow. Like if you
True.
see a lot of the crypto guys who started companies were typically very young kids who were exploring crypto or Web3 when they were in third year, fourth year, and then after 3 4 years it became a big deal. Uh, Even like there are some of the companies we backed in college from college entrepreneurs. We did this deal called Bytespeed, for example. The founder was in the when I first met him, he was in third year. Then by the time I met him in fourth year, it felt like I met a different person altogether. Like he had just grown so much in that one
Mhm.
year. He had gotten customers. He had launched his product. He had not even graduated, and he had like a full like a business that was doing some $1,000 in MRR.
Mm.
And then we invested, and then Sequoia Search came in, and so on. So, uh, yeah, like I don't think. Sorry, your original question was how do you look for a
Yeah,
like
founder market fit in someone much
because
younger.
with Lightspeed guy, for example, he uh I saw his personal growth very clearly. Like I could
Mm.
see him in 2019 and what he was in 2020. And this kind of person, like if you see somebody growing that fast, then usually that's the person that's going to be hard to compete with,
It's
like a
outlier, yeah.
type of force of nature type of founder. Uh,
So it's not maybe not so much about founder market fit, but just about founder fit.
it's both. Like so sometimes like for example, Rigi when we backed, right?
Mm.
Rigi guys had run a company called Hala Play before they started Rigi.
Riggy isn't Riggy Club, the
Yeah,
creator one.
yeah, the
Okay.
creator one. Nowadays they're running ads in multiple
Yeah,
places,
yeah.
the more popular. But they had run a company called Hala Play, which was at one point the second biggest fantasy app after Dream 11. Uh,
Mm.
Before MPL has started, and they had raised some money. They had 2 3 rounds of funding, and they had an acquisition also. Nazara bought that company. So they were close to this creator audience who was creating fantasy teams on Telegram. So many of they had seen these groups where there were many of them, running these paid groups where they will give tips. Ki this is the kind of team you can set today, and where you will win something. And there are lakhs of these groups running. So and the groups were not just for fantasy; they were running for stock tips, crypto tips, astrology tips, all kinds of monetizable information was being shared on Telegram groups, and these creators were manually running these groups. Manually means if on my group there are 500 people, I will every month check, okay, these 450 paid. I will create a new group and put 450 people here and remove 50 people, and then again do that.
Mm.
And so every month you have to imagine, having an Excel sheet to check kisne paisa
Yeah.
diya and tallying that, and the nightmare. So these guys came to us saying ki this is how it's working. They all these, and I had also seen these groups. It was not an unknown thing, but I didn't know that it was that hard to run a group like that. So they
Mm.
gave me a very specific insight. Look, there are so many of them. All of them are struggling. What if I give them a very simple way to run this group where automatically billing happens. I give them more features to monetize. Like they had ideas like, if I swipe if you get a message, it appears with a lock on top of it. If you
Correct.
swipe, pay 5 rupees, it unlocks. So you can monetize per message also, not just for the entire group, right? So they had a lot of great ideas like that. But that is what I call the earned secret team. Like because they had run Hala Play, because they had been in that space, they knew this audience exists and they knew how big this audience was, and they knew this problem also exists. So, and they had built a consumer tech product in the past, right? So it was a good bet to make that they have a clear right to win. There are other people who caught on to the problem also, but later on, like, so they had an edge. Sorry. So it was a good team to back, and they had this edge to, both to discover the problem and their past experience of building Hala Play, scaling it. We knew that this is a team that can build a heavy transactional volume product. They understand consumer tech. They understand how consumer UIs need to be like, and acquisition, all that they had done in the past. So all that we knew they'll be good at doing.
Interesting. And what is one trait that you've seen exceptional amongst some of the best founders?
I think the all-in trade for one, like they really have all their eggs in one basket and they watch that basket closely. They're always on. There's no there's nothing else in their life really, like that. Like they have a family, maybe they work out once in a while, but that's their company, all they care about, all they think about, all they do. Like they're literally all in on that one opportunity that they're working on. Usually they also are great with one particular skill set. Like they have this T-shaped persona where broadly they're good at multiple things, but they have one superpower also. Like either they're exceptional coders or exceptional at branding, exceptional at selling. So something like that is one more persona, but this is not that strong. Actually, the first one is the all-in-one, then the uh, customer centricity is also clearly something which all of them have. Like most of them will know their customers by name. They will have them on their WhatsApp list. They'll have like a bunch of people who use their product or are their clients whom they directly talk to. Even
Interact with, yeah.
year 5, 6 of their journey, year 10 of the journey also, they know people by name who use their product and who directly give them feedback on what's working, what's not working. So that just that closeness to the actual user of their product is also very, very common.
Interesting. Okay, I think this is the most important question I've been wanting to ask. How do you arrive at a valuation for a pre-product or pre-revenue or just an idea state startup in many cases?
So see, there's no sort of formula for this. It's basically a negotiation between the VC and the founder. The VC has to do some math that, okay, what is the likely outcome of this company? If this becomes a $500 million company or a $1 billion company, it should return my fund. So for me, that math is at that point, I should have at least, like my ownership, if it becomes a 1 billion company, I should at least own 1% so that my 10 million fund gets returned minimum, right? Ideally, I should own more so that it gives me a 2-3x on the fund. That means my starting ownership has to be 4-5%, right? Because there'll be multiple rounds of funding, and over time, this company will dilute in seed, series A, B, C, D, and my 4%, I'll be left with maybe 2% or 1.5% at that time, and then I can sell and I can return my fund. So that's basically what the VC is modeling for. The founder is going to model for what's the best deal I'm getting. Like Kushal's giving me a 2 million valuation, maybe Krishna might give me 4, Sequoia might give me 10. So as a founder, you're well within your right, or to basically get the most amount of money you can for the least amount of dilution. It's very much like selling a house, for example, right? Like you go to 4-5 people, some guy will say I'll pay you 1 crore, somebody will say 1.5 crore also. So it's a market determined price in a way.
But is the VC's mindset always about only at 1 billion valuation I want my fund to be returned? Or in many cases, do you think this might at max become a 500-600 million company, but it's still a reasonable investment? Or it might be a 100 billion company and we might need a smaller bit of it?
So 100 billion is extremely rare. So, and that too, to do 100 billion in 8 years, 10 years is like next to impossible. Maybe it will happen, but there'll be like one case in the whole decade. Okay, like if I look at the last 10 years, I don't know of which company is 100 billion valuation like within 8 years, right? Like, people do manage to do it over 10, 15 years. Like Facebook was the last great one. Uber also, I not 100. Uber also,
Stripe, I think.
Stripe was also never 100 billion. They were at 90 in the private markets. Now they're at 50 after the crash. So 100 billion is just, this doesn't happen. It's that was low interest rate phenomena, if I may put it that way. Likely I would see I think there are not even 100 companies in the world which do more than 1 billion revenue in just software. The
Correct.
number is 20 or 30, I think. I think so. I'm not very sure. But so 100 million out of the question, like this is our markets worldwide are not that big to support those kind of outcomes. Even in India, the number of companies listed, like people have gone public, their stock is listed. There are only 300 companies above a 1 billion valuation in the whole of India. So this includes our mines, auto companies, Maruti, HDFC Bank, insurance, everything. That's it.
Yeah.
So the odds that your company is going to be one of them is actually astronomically low. Okay. So even a 500 million company is actually very difficult to build, and it's very rare that somebody can do that. And I'm talking about real 500 million, 1 billion valuations, not private market valuations, right? Private market is basically means one person agreed that you are worth $1 billion and gave you 100 million and bought 10% of your company. It doesn't mean you're really worth $1 billion. Okay. So that the odds are basically very tough. That's essentially what I'm trying to say.
Got it. And this is largely governed by the fact that your fund term is something like 7 to 8 years.
Yeah, our fund term is 10 years, but yeah, we hope to return capital in like by year 7, 8, we hope to sort of start returning capital. Yes, governed by that, and also governed by the size of the fund and the amount of number of bets we are willing to take. So usually we expect a 50x to 100x outcome from the company that we are investing in. So that means I have to ideally get in at 3 million, 4 million, 2 million valuation to justify to basically return my fund when the company becomes worth 300 million or 500 million or $1 billion. But it's again, as I said, a negotiation. Sometimes you meet a team where you think you're taking too much risk. There's no product. The guy has not done anything like this before, but you're taking an intuition-led bet that they'll figure it out. So then you'll maybe do that at 2. Sometimes you meet a second-time founder who's been there, done that. A lot of things will go right. Another VC is also putting more money. So you're starting with a 5 million. So there's no like set formula for it, but at least at us, our company, like at Firstcheque, usually we should do it at a 2 million valuation range. At all in, we are comfortable up to 3, 4, sometimes 5 million. That's the range where pre-product early stage companies get money. But yeah, like there are all kinds of models. Like for example, a Sequoia Search typically does a 2 on 10, or larger funds like Accel. All of them they're quite comfortable giving you 2 million on 10 million. But then they again have a different lens through which they evaluate. Usually they look for some traction, some proof of
market adoption.
Yeah, so they also do pre-product once in a while, but yeah, everybody has a different lens through which they evaluate. So they have their own math. For them, the fund returning number is, I think, 2-3 billion. Their fund itself is $2 billion fund. I think Sequoia India Accel is probably 700 or $1 billion fund. So they need multiple winners, and they need outcomes of $3, $4, $5 billion where they own 20% of that company to return a large chunk of their fund. So yeah, basically for the VC, this is the math, that how much of this company do I own and how much should I be owning when this company becomes the next Flipkart or Swiggy or Mama or whatever, such that when it does become big, my fund gets returned.
Interesting. And I'm not sure if my data is right, but at least here's what my perception is. I think the sheer number by percentage of deals, the number of companies that Firstcheque has backed seems to have gone on to raise a Series A compared to most other early stage funds. Firstly, is that true? And if that is true, how is it that
you're saying the number has been more than other funds?
Yeah. So as a percentage of deals, the number of companies, the percentage of companies backed by FirstCheque have gone on and raised a Series A, that number is higher than those backed by other early stage funds.
Yeah, so I would like to think as yes, but I don't have a very anecdotally yes is the answer. I think that so I wouldn't say Series A. Let's say one follow-on round. So in 2021 and 2022, a seed round became 2-3 million. Some people got $5 million also as a seed round. So that number used to be a Series A number in 2018-19. Seed round used to be 1 million or 500K and like 3-4 million plus for Series A. But if you just say backed by a good brand name VC and raised it $1.52 million more after our round, I think about 65-70% of our companies got there.
Yeah, that's a phenomenal return, right?
It was quite a good bump up. Yes, so the answer is yes, but these are also very market driven. So there was an upswing in number of deals happening in 21-22. So I would not take all the credit for that. It was just
sure, but it's also true that in 2019, other early stage funds would have also invested in companies, but not all of them got these returns despite the market, favorability. But
true. But again, so I agree with your assessment that yes, it was maybe higher than other early stage funds, but I also would like to say that it's not really that relevant a metric. Like it's a good signal that okay, they're doing some picking right, but we really know if this is working only when some of these companies become like $1 billion company with revenues and the fund exits its stake and returns money to its investors. Then you can say that yes, this worked out. Till that, because if you look at if you've been around long enough in the game, you will know you look at cohort from 2015-16 also, right? Lot of them raised money. People who started in 2012-13 raised Series A's in 14-15, and then a lot of them shut down.
Right.
So just getting to a Series A is not a definitive answer that this is now made it. It means as a bucket of portfolio of investment, this is a good pool, but to be seen basically on how it converts into actual cash back for LPs.
Interesting. I let me just pull up one tweet. I was reading this today when I was going through your Twitter. So I think I mentioned about one bad market anecdote where one of the founder angels knew about someone, some company that had shut down when they applied for a job and then eventually did not land the job either. Of course, I don't want to get into the details of the company and the person and stuff, but how is this a likely scenario that an investor who actually thought this person is good enough and put money in them did not find them good enough to join the team?
It's obviously a bad situation because usually founders are supposed to be exceptionally good at least one thing, like I said earlier, right?
Right.
So, like I was good at sales, which is why Upgrad hired me when my startup didn't work out. So maybe it was a bad pick. Like this founder angel basically backed a company which in a normal market maybe would not have raised money, but because of the euphoria of 21-22, a lot of people got money, which inefficient market in a way, right? People who should not have been able to raise money did raise money. But yeah, it could also just be that they were a better fit somewhere else. I don't know. Like this, I was just stating one anecdote. I'm sure the guy did find a job somewhere else. So it's not like he was completely useless or had no skills out there. Maybe it's just not a fit for his own company. But yeah, it was definitely a sign of the times where people were shutting down companies. And I mean, the anecdote for me was more about the founder not having the decency to tell their investors that, listen, this is not and I'm shutting down, and this is what we learned, and I tried my that's like a courtesy call is basically what you should at least do, right? If you've taken somebody's money and you calling it quits, like it's okay, it happens, but like the least you can do is send an email at least to everybody saying, this is what happened, this is what I'm doing, and this is why we're shutting down, if not a phone call. So that was the striking part, that he didn't do that was the shocking part of the story. Yeah.
Interesting. And what is the right way to build a pitch?
Pitch to an investor?
To an investor, yes.
So I think, I mean, there much has been written and spoken about this, but basically, see, as I said, this math is what a VC is looking for. That this can I find a company which will become the next $1, $2, $3 billion company.
Correct.
You have to make a case that if I can get to 100, 200 million in revenues in the next 5, 6 years, that should look likely from your pitch. Okay, so you have to find a large market, and like you have to start with a problem, that this is a problem that people have or businesses have. Why is it a big problem? Why is it like so painful? Like how I explained the Rigi problem, right? Like there are these creators, they have this problem. They're very clearly a problem. Why is it a big problem? Why, like, what are they currently doing to solve the problem, and why is that broken?
So by big problem, do you mean a functional problem which is faced by a lot of people?
Ideally, the pain of the problem should be big. Like that is when your product flies off the shelf. Okay. And second part of how many people have this problem, that also, yes, should be a big number. But usually what we've seen is in the beginning, there are a small number of people who have this problem, but that number is growing exponentially. Okay. Like creators, for like the Rigi example, if I take, you can make a case that because now Rigi exists, a lot more people will become creators and start running these groups because it's that easy to run a business like that now.
Correct. Yeah.
Okay. So if you look at the exact number of people in 2020 or 2021, it may not be that big that you can easily make a case for a 100 million revenue company. But good sort of good tech products sort of create these markets hand in hand. Like even Coinbase, if you take, right, when they started, there was Bitcoin was basically something these nerds used to buy, which regular people should think like, okay, whatever, like what am I going to do with the internet money? So there was a very few number of people who were actually buying cryptocurrency and Bitcoin, but because Coinbase and the other exchanges came into being, they expanded the market, and then they made it easier to buy and hold cryptocurrency, sell the cryptocurrency. So a lot more people came in, and that number sort of exponentially grew. So you have to look for these cases. So because if it is already an existing large market with a lot of people having the pain point, then likely a large company will come and solve that. Okay, the opportunity for startups is where this kind of unique space exists, where there's a big problem for a small number of people, but that number is growing very fast. Okay, so that is a very sweet spot to sort of start a startup, because then you can grow with that market and build a very large company. So you have to build a case for that in your pitch, that why is this a problem? Why is my solution the best solution? Why am I the best person to solve this problem? What edge do I have here? How will I find more people who have this problem? How will I get what is the problem? What is the product which solves this problem? Why is this the best product? How will this product get to all the people who have this problem? How will I build distribution basically? How will I acquire users? And how will I make money? Will they pay me? Will somebody else pay me? How much will they pay? Right. So basically these 7 to 10 questions you have to have clear answers for. It's okay to say I don't know for some of them, but like at least 70-80% of them you should have a clear answer to.
Interesting. And how do you, as a VC, how do you view the competitive landscape? Let's say some other companies have been funded recently in this space, maybe doing something similar. So is that more of a conviction in telling, okay, someone else is believing in this idea, so maybe here's a better bet, and maybe if this founder executes better, we could stand a chance to win? Or is it more like telling, okay, 2 people have already done it and maybe they are early movers, so maybe it's not a good idea to back it now?
So it depends on case to case, but I would say usually when there are existing players, it's a good sign that it means there's a real problem. Then the question to ask is this team better than the other people who have already launched? So do they have any unique insight? Do they have some special access to distribution, or do they have some kind of shipping ability which is better than the others? So these questions you have to basically get an answer to on why will this team sort of win against the others. And this also is a question of, is it a winner take all market? There are some cases where, like financial services, most plays are never winner take all. You always have multiple banks, multiple insurance companies, multiple payments companies, and so on, right? So usually there is no winner take all dynamic. So if it's not a winner take all dynamic, then there may be 3-4 winners, 5 winners, 10 winners also. If it is a winner take all dynamic, then you have to very specifically look at, will this person be able to raise the most money? Will they build the best product? Will they grow the fastest, right? So then all these questions come into play.
Interesting. Speaking more about unique insight itself, like, I mean, have you come across any interesting examples of unique insights?
Yeah, like I mentioned, the Riggy guys, right? They had that creator. They knew these guys had a problem, or Jiva knew about Indian women wearing can't affording not being able to afford gold and yet wearing Western wear, so they wanted something to go with that. Uh, Another sort of example maybe I could give is uh,
So, in most of the cases, what you're saying is unique insight is the problem itself.
yeah, generally that the problem is there, and there exists a way to solve that problem which I know about. Right, like
Hmm.
Chiva's case, the problem was that there's gold has become expensive and there's not enough nothing good jewelry to wear with. There's no good jewelry to wear with Western wear in India, so silver came as a solution to that problem. Uh, but yeah, usually it's both identification of this, a problem which a small group of people have, which is growing very fast, and a solution which the founder has discovered that okay, this is how we can solve this problem, and that solution should be tech enabled in the ideal case.
Hmm. And what about investing gave you the conviction that this is what you want to do and not go back and start up again?
So I looked at the guys who were making it big, right, and I realized how difficult and how painful it is, and honestly felt that I don't know if I can do this, right? Like some of the guys that we work closely with and who've now become unicorns, or uh, build these very large businesses. uh, I just felt like I'm more of a guy who can coach people when at the 0 to 1 journey, but I don't know if I can do this 1 to 10 thing that these guys have done, which is hiring large teams, going on raising capital, building 500,000, 2,000, 3,000 people companies. It's just basically a personality fit of sorts, I guess. Like I felt that this, I used to think I want to do it, but by when I worked closely with these founders, I sort of decided I don't want to do that. I want to work with these guys in the early stage, help them get to a certain destination, and play my part in that journey that way. Uh,
Hmm.
so yeah, that's sort of like somewhere around year 3 of Firstcheque is where I had that realization.
Okay. So let's say when a VC is building their team as part of the VC firm itself, what do
Yeah.
you look for in your analysts or principals or investors, whatever? Like
So we
how do
have a
you?
very small team. It's just me and my partner Aditya, and we've just onboarded our first analyst. But otherwise, uh, curiosity for me is number one. Like, is this person genuinely curious about everything in the way the world works? Uh, and like just free flowing, wide curiosity about anything and everything helps you be a better VC. Then second is interpersonal social skills. Can they basically sell themselves and the fund, and get us into great companies? Can they build relationships with people who will send them great investment opportunities? And then obviously, can they work? How valuable can they be to an early stage founder? Have they
Hmm.
built something in the past? Are they in a position to advise founders on what they should be doing? So these three things is basically like just wide intellectual heft or slash curiosity, interpersonal skills, being able to build relationships, and three, some past experience of building stuff which you can give back with to founders.
Okay. And have you noticed something significantly different given the fact that you operate with or you work closely with founders who are now operating as angels, as opposed to traditional VC firms, which are mostly dealing with free flowing capital out there?
Yeah, so founder angels generally are way more liberal when they usually pick people. They don't they don't think too much about market and growth and this that. Like they meet a person, and if they really like somebody, they'll back them.
Hmm.
Especially if that person has some way or the other is known to them, whether they worked at their company or the college batchmate, or something, like if it's somebody in their extended social network. Um, or even if somebody walked through the door and somebody else referred them to this person, If they really like somebody, they go and back them. They usually just pick people that they vibe with. Uh, Whereas a VC fund has to build a more detailed thesis on,
Right.
what is gross margin going to be like, and how big is the market, and who will buy this company after 10 years, and all of those questions is what a VC will think about. Whereas a founder angel can take a bet more aggressively.
And speaking of curiosity that you mentioned that you look for in your team as an investor, um, has there anyway has there been an instance where you felt you were actively thinking, why is no one building this particular problem, this particular solution, why is no one solving this particular problem, or it's high time for this product, and have you seen like the right kind of solution or the right kind of startup comes in at that point trying to do this?
Yeah, sorry, it's happened some multiple times. I think one example was Super K. Super K is this chain of offline Kirana stores in a branded format. Let's think of it as Oyo for Kirana store. So they have a brand. They basically find a local entrepreneur. They set up the shop for them with their Super K brand. They supply goods to the shop. They decide how it will be priced, what the shop will look like, where things will be kept within the shop. They restock when stuff go. They run discounts. So everything strategic about the business they run, and everything ops driven, where the guys who sit on the shop, smile at customers, bill them, and make sure nobody's stealing stuff from the shop, etc., keep it clean, all that stuff the entrepreneur does. So this, I had read a book called Supermarket Wala by Damodar Mall. He was the founding CEO of DMart and the later on Reliance Retail. So he had written a great book on how to set up a supermarket. Like, what is the difference between a Kirana shop and a supermarket, and why supermarkets sell more per square foot compared to a Kirana store. And he basically wrote a book telling Kirana walas how you can build a supermarket. Like, he wanted more modern trade in India. So that was a thesis. And then I realized, okay, this is actually a playbook to do this. This is not uh, this is not some random like reason why these chains. There's a science behind how these retail chains work. And I had thought that, okay, it is actually somebody can build this now with tech as the backbone. You can actually create a chain of shops where these local entrepreneurs put in their capital and run them, but you tell them exactly what to do and how to do it, and there's a large amount of control you exercise over them through supply and through brand. So Super K came along, and basically when they pitched, I was like, yeah, this is exactly what I had in mind. And I read that book, I think, a year before they met me. So it just clicked really well. Or even Kutuki was sort of like that. At Nayi Disha, we had tried to make a Peppa Pig or Sesame Street for India. Right towards the end, we ran out of money. Uh, Peppa Kutuki came with the same thesis that Indian kids, basically, you will see a lot of Indian kids talking British accents now because they've watched only Peppa Pig and these other sort of cartoons on YouTube. And in those cartoons are very disconnected from India's culture. Like, there's no grandmom, granddad in the cartoon, and there's no Diwali episode. There's a Halloween episode, and there is there's no content in Kannada or Tamil or Marathi or so on. Right? So Kutugi's thesis was, why we'll create a universe for Indian kids with Indian values and Indian cultural references, and like we'll make that the Peppa Pig of India. So and they're doing quite well now. After we backed them, then they raised money from OMDR also. So that was another one, I think, where I had an existing thesis of sorts, and a founder came in and matched that thesis.
Interesting. One concluding question, Kushal. If you were a 22-year-old out of college now in 2023, what would you do?
Interesting question. So I don't know. Honestly, it's very difficult to give one straight bracket advice to everybody, right? Because
No, I'm not asking for an advice. What would you do?
What would I do?
Yeah.
I would basically, I guess, just spend more time building stuff again. I would actually do the same things I did. I don't think I would change anything in my journey. I let myself really explore things that piqued my curiosity, and I went down different rabbit holes. I would do more of that. Like, I would not. I would basically just do more of what I did, which is go down basically go down paths which it interested me with no idea of where they'll connect in the future. Like as Steve Jobs said, right? Like the dots
Yeah.
all connect in hindsight. So have that faith on your intuition and go explore things that interest you.
And if you were to build a startup now, what would you be building?
Or definitely in AI, I guess. Like everything is like AI is definitely clearly looks like a new paradigm of technology that is happening. Like what the thesis we are working with right now is that how the industrial revolution scaled manufacturing, AI is going to scale services.
Hmm.
So whatever jobs or whatever product you consume where there's a human servicing you on the other side, it's possible that will get delivered by AI over time. So and I think that will create a lot of abundance in the world. Like for example, how nowadays all of us have like 20 plus clothes, right? T-shirts, jeans, etc. Pre-industrial revolution, people used to have two. You will have one
Hmm.
shirt and one pant, which your mom suit for you. But once you scale fashion, like everybody now, like people have 500 clothes also, right? So
Right.
similar thing will happen for services where wherever there is untapped demand, like entertainment, for example, education, healthcare. These are things where there is no education for them. There's no limit to how much you can learn. You can go on learning for life, right? So but there's no teacher who can teach you for 20 hours a day, right? But AI can do that. So a
Hmm.
lot of these services businesses will become scaled, and I think we are entering an era of abundance. So AI is definitely a very, very interesting space to be in right now.
Interesting. Thanks for this conversation, Kushal. It's been fun reflecting on your journey and learning more about how a VC thinks about the world.
Thanks, Krishna. My pleasure to be here.